Hey everyone, this is Juicy here. It's been a while, but I'm coming back just to give you a little update on what I've been doing, as well as just give you some educational advice on stuff like that. But yeah, so one of the things I kind of want to go over is, with how the market is doing. I'm pretty sure you've noticed, a lot of these charts that you see here on the right, you can kind of tell that they're all kind of very similar, right? They're all like following the same type of trend, even though each coin is very different, they all have a different service or protocol. Like how come some of these are just following the same chart or the same graph, right? You have some stuff that are just one-offs are doing really, really well. But you can see like, Bitcoin, Ethereum are pretty much the same. BNB just recently had like this huge, spike in growth. I think like a couple weeks ago, and now people are just selling off. So there's some things that you can tell, like, the reasons why, but some of these are just very similar. Like the charts are just the same. And why is that? Now, if you want to know why, how come a lot of these, graphs are, following like Bitcoin's chart or following like Ethereum's chart, is because of liquidity pools. Liquidity pools are pretty much like two coins that a liquidity provider, incentivizes, where, you put in, usually a blue chip or a stable coin and then the token itself. So a lot of these new projects, what they do is they create these within DEXs, decentralized exchanges, like SushiSwap, Unipool, SushiSwap, Uniswap, and like 1inch. They provide these DEXs where these cryptocurrency projects can essentially create liquidity pools where you stake the token that they created, and then a well-known token or coin such as like a stable coin or a blue chip, and helps incentivize and stabilize that liquidity pool. Now, the biggest thing about these is they're smart contracts. Liquidity pool providers can actually take out the funds from these liquidity pools in order to fund their projects, right? So you're essentially helping them, and you're pretty much like I guess you can say like a venture capitalist, right? You're buying the token of their, let's say, token A, right? And that increases their trading volumes and increases their prices. And you're also giving them money, right? Funding them money through the blue chip token, whether that's a stable coin, like USDT, USDC, or you can provide Ethereum or Bitcoin. Now, in order to incentivize them, or I guess traders or users, they give you like side yields depending on which tokens you stake in the liquidity pool. So that pretty much incentivizes you to provide that, and that's why you don't really gain as much gains when you actually just stake just by buying the coin itself or staking just the coin. You usually get better yields or return if you do within the liquidity pools. Now, the reason why that there is impermanent loss, which essentially means that at the time when you stake and you buy both the token for the company or the cryptocurrency, and then you have a 1-to-1 ratio with, let's say, a stable coin, or actually better yet, let's say you stake it liquidity pool with like Ethereum and Bitcoin. The values will fluctuate between that blue chip that you bought or that you have, and then the new coin that you have purchased for this liquidity pool. So since it has to be 1-to-1, if one increases or one decreases, that 1-to-1 ratio has to be the same. So you do have impermanent loss. There's a lot of videos about it, just about what it means and what it does. And that's the reason why it's better just to stake in a liquidity pool a stable coin, because a stable coin, that's one side of the liquidity pool that's always going to remain a stable price, right? So it'll never fluctuate, RIP Luna and Luna tokens, but that's pretty much reason. So the only thing that would fluctuate is actually the token that you bought for that liquidity pool, right? So and that's the good thing about buying a liquidity pool that's staked or pegged to a stable coin. So because there's a less chance or less of a factor of impermanent loss. So yeah, I hope that's self-explanatory or very helpful on why. Another biggest things is that since all of the liquidity pools are on DEXs, a lot of those things are pretty much automated. So if you don't know, it's called like AMM, automated market makers. Pretty much it just allows those digital assets to be not autonomous, but automated, where when people like buy and sell, those are used in order to stabilize that liquidity pools, and for that impermanent loss. So a lot of that stuff is pretty much behind the scenes. So therefore, if the token that you bought, like token A, right, that's not like a blue chip or a stable coin, that has to be kind of balanced, right? So that's kind of automated in that sense. So that's why you see a lot of things, especially when all the market looks the same, is because it's impacted by that. So that's the reason why. So I hope that is very understandable, and I hope I put it into I guess a digestible format. Now, one thing I do want to talk about, since it is a major issue, I guess, in privacy, is Tornado Cash. If you guys don't know, US pretty much sanctioned Tornado Cash because hacker groups were using it. You can see here, this includes almost 500,000, 455 million stolen, right, from a North Korean hacker group, right? So a lot of this stuff, unfortunately, with Tornado Cash was used by malicious people. Doesn't necessarily mean that Tornado Cash was intended to be used maliciously, but unfortunately that is the case. And you can see here that a lot of stuff, the good thing about Tornado Cash is that it is somewhat open source, but you can see here that like this is their websites, and a lot of it has been taken down, or I need to sign up. This is like one of the things of their website. There's a lot of things happening. They give you a lot of, Tornado Cash was audited due to issues with the F domain. So there's a lot of things going on in the background. Another thing I want to talk about would be the Ethereum proof of work, ETHW now. I think for this, I can see why people want it, just because there is a huge amount of miners that are just gonna become obsolete. Now, I think everyone that does decide to stick with the proof of work of Ethereum, they're just going to be left in the dust. Anyone who decides to do this, it may last pretty decent in the beginning, just because it's a pretty new coin, and there's going to be a bunch of people pushing for it hard. But the value, the legitimacy of Ethereum or ETHW will slowly, be the downfall of the coin itself. Now, the good news is that there's a lot of things or support for the proof of stake. For example, Chainlink, which is an Oracle node that is predominantly used in Ethereum's EVM and network. They're pretty much, they provide they provide data and information for Ethereum. They're only going to support the legitimate proof of stake or Ethereum 2.0. And then there's a lot of issues with Ethereum ETHW, in my opinion. And I don't think that, I think it's just going to cause more headaches and more issues, as well as, there's going to be a lot of people, especially, since ETHW or Ethereum W is going to have all the previous blockchains of all the previous transactions. There's going to be some cutoff point where it's just going to be everything about it is going to be illegitimate, because people can leverage the previous blockchains in order to, I don't know, let's say snag a previous thing that they had ownership. So there's a lot of issues that I see with it, and it's just gonna probably pump a little bit in the beginning, and then it's just gonna die down. Um, but yeah, that's just my honest opinion. Some of the things that I've actually been doing recently. One of the things is I've purchased some Lyra Finance tokens, just because GMX has been doing so well. I'm pretty confident and bullish with Lyra, so I've purchased a few Lyra tokens and staked it. Another thing that I've decided to do is purchase Ethereum on a daily basis. I was, going on YouTube, and one person that I've been listening to, as we're respected, he actually went on a recent, I guess, like show or YouTube show, and he talked about, that he just dollar cost averages his cryptocurrencies, as well as his stock exchange portfolio, and I thought that was really interesting. And I'm pretty sure you've heard it from a bunch of people both the time, especially like Benjamin Cohen, where dollar cost average or people who hodl are more successful. And since right now, in my opinion, is the accumulation phase, I don't expect Ethereum or Bitcoin to drop dramatically unless something like really bad happens, like a war, right? I think I've mentioned this in a previous video. The only thing that would really stop the growth of Bitcoin or Ethereum is if a war, like a World War III, actually breaks out. If that happens, unfortunately, yeah, like there's no point of innovation or growth. That's just how it is. As long as there's innovation and growth, there's always going to be work on new technologies and new advancements in society. So that's how I see it. So yeah. So I decided to do dollar cost average. I'm buying, a small portion of Ethereum every single day. But I will probably purchase, some amount of Ethereum, maybe now until the proof of stake. I'm pretty sure there'll be a nice little pump, and then I'm pretty confident it will be up to like maybe like 2400 will be a nice price in my opinion. But if that does happen, I think I might just sell it maybe within the next couple of days after the proof of stake happens, just to get a nice profit, because I haven't really necessarily been doing that. And I think I kind of want to test the waters now with just trying to buy and sell when it comes to blue chip tokens. Instead of me hodling, I think hodling is a good approach, especially if you have blue chips. But I think you also need to cut your losses at certain times, especially if you're holding a coin that that makes you lose thousands, which has happened to me a lot. And I think the issue is that I didn't cut my losses short. So that's something that I'm really taking seriously, and making sure that I follow the things that I should be doing properly in order for my portfolio to grow, as well as to cut any losses. So hope that was really helpful. I'll catch you guys later. Juicy out.